There's a rule sitting inside the tax code right now that lets you pull tens of thousands of dollars out of an account in retirement and hand the IRS nothing. Not a discount, not a deferral, zero. And most people who have the account don't actually understand why it works, so they either underuse it or they touch it wrong and lose the benefit entirely. This isn't a loophole. It's not something your accountant is hiding from you. It's written into the code. It's been there since 1997, and almost nobody explains it the way it actually functions. In this video, I'm going to walk you through exactly how tax-free retirement withdrawals work, why the mechanism exists, and where people accidentally disqualify themselves from money that was supposed to be theirs. Here's the story most people absorb without ever being taught it directly. You save for retirement, and one day when you pull that money out, the government takes its cut. That's just how it works. You earned it, you deferred it, now you pay the bill. It feels like the natural extension of every other tax rule in your life. That story is mostly true for one type of account, but there's a second type of account sitting right next to it that plays by a completely different set of rules, and most people never learn the difference clearly enough to use it on purpose. A 2023 Federal Reserve survey on household economics found that a large share of working adults couldn't correctly identify how their own retirement account would be taxed at withdrawal. Not people who don't save, people who actively contribute every paycheck, watch their balance grow, and still can't tell you what happens the day they take the money out. That's not a knowledge gap caused by laziness. It's a gap caused by nobody explaining the mechanism plainly, because there's no one whose job it is to walk you through it. Here's the mechanism. There are two broad buckets for retirement money in the US, traditional accounts and Roth accounts. With a traditional account, you get a tax break the year you contribute. The money goes in before taxes, it grows, and then when you withdraw it in retirement, it gets taxed as regular income. That's the version everyone already understands. It matches the intuitive story. The Roth version flips the order entirely. You contribute money you've already paid taxes on, no deduction today, but in exchange, the growth, every dollar of it, compounds completely tax-free. And when you withdraw it in retirement, under qualifying conditions, you owe nothing. Not on your original contributions, not on decades of gains sitting on top of them. That distinction is the entire game, and most people treat both accounts as functionally the same thing because they both say retirement on the label. Let's put a real number on it so it actually lands. Say you're 30 years old and you put $6,500 a year into a Roth IRA consistently for 35 years. At a conservative 7% average annual return, that account grows to somewhere north of $900,000 by the time you're 65. Your actual contributions across those 35 years total roughly $227,000. Everything above that, over $670,000, is pure growth. In a traditional account, that growth gets taxed as income the moment you withdraw it. In a Roth account, all $900,000 comes out completely untouched by federal tax. That's not a rounding error. That's the difference between retiring comfortably and retiring with real financial slack. So why doesn't everyone just use a Roth account for everything? Because the psychology works against it, the same way it works against almost every long-term financial decision. Behavioral economists call this present bias, the tendency to overweight an immediate reward against a delayed one, even when the delayed reward is objectively larger. A tax deduction today feels real. It shows up on this year's return. A tax exemption 30 years from now feels abstract, almost theoretical, because your brain has trouble modeling a version of you that's 3 decades older. So people default to the traditional account, chase the immediate deduction, and never revisit the decision, even as their income and life situation change around them. There's a second reason this stays hidden, and it's structural, not psychological. Your employer's 401k plan is almost always set up as traditional by default. Unless you actively opt into a Roth option, if your plan even offers one, your contributions flow into the tax later bucket automatically. Nobody sits you down during onboarding and explains the trade-off. You just check a box during a stressful first week at a new job, and that box quietly determines how a chunk of your future wealth gets taxed for the next several decades. Now here's where people get the rule wrong, and this is the part that actually costs money. A Roth account isn't automatically tax-free the second you touch it. There are two conditions that have to be met, and missing either one turns tax-free growth into a taxable penalized withdrawal. First, the account has to be at least 5 years old, measured from January 1st of the year you made your first contribution. This is called the 5-year rule, and it applies even if you're well past the standard retirement age. Second, you generally need to be at least 59 and a half. Hit both conditions, and withdrawals, including all the growth, come out completely tax and penalty-free. Miss one, and depending on the specifics, you can end up owing tax on the earnings, plus a 10% penalty on top of that. Here's the part almost nobody tells you. Your original contributions to a Roth IRA can always come out at any time, at any age, tax and penalty free because you already paid tax on that money going in. It's only the growth, the earnings on top of your contributions, that's subject to those two conditions. That distinction alone changes how a lot of people think about emergency access to these accounts. There's also an income ceiling most people don't find out about until they've already tried to contribute. For 2025, if you're a single filer earning above roughly $165,000, or a married couple filing jointly earning above roughly $246,000, you're phased out of contributing directly to a Roth IRA at all. High earners assume this rule locks them out permanently. It doesn't. There's a completely legal workaround called a backdoor Roth conversion, where you contribute to a traditional IRA with no income limit and then convert it to a Roth shortly after. It takes an extra step, and it involves some tax nuance if you have other traditional IRA balances, but it's a standard, widely used strategy, not a gray area. Let's talk about why this particular rule sits in the blind spot it does. The first reason is what psychologists call temporal discounting, the same mental shortcut that makes $1 today feel more valuable than $2 a decade from now, even when the math clearly favors waiting. Retirement tax strategy requires you to make a decision now that only pays off in a future you can't fully picture. Your brain resists that trade by default. The second reason is the default effect. Whatever option is pre-selected for you, whether that's your 401k's default contribution type or the account your bank pushes you toward when you open an IRA, becomes the option most people never question. Nobody's incentivized to walk you through the alternative, so the default just quietly becomes the outcome. The third reason is that this information lives inside IRS Publication 590, a document that runs well over 100 pages of dense legal language, written for tax professionals, not for the 28-year-old opening their first retirement account during a lunch break. The rule is technically public. It's practically inaccessible to almost everyone it's designed to help. Here's a scenario that makes the stakes concrete. Two people, same age, same income, same $6,500 annual contribution. One puts everything into a traditional 401k. The other splits contributions between traditional and Roth, understanding that a mix gives them flexibility to control their taxable income in retirement. 35 years later, the first person retires with a large traditional balance and discovers that every withdrawal pushes them into a higher tax bracket, sometimes affecting how much of their Social Security gets taxed too. The second person can pull from their Roth balance in high-expense years without touching their tax bracket at all. Same discipline, same savings rate, completely different level of control at the finish line. That control matters more than people expect because retirement withdrawals don't happen in a vacuum. Required minimum distributions on traditional accounts force you to start withdrawing and paying tax on that money, starting at age 73, whether you need the income that year or not. Roth IRAs have no required minimum distributions during the original owner's lifetime. That money can keep compounding untouched for as long as you want it to. There's one more piece of this that almost never gets mentioned, and it involves what happens after you're gone. If you pass a Roth IRA to your heirs, they inherit it tax-free, though they do generally need to withdraw the full balance within 10 years under current rules. Compare that to a traditional account passed down, where every withdrawal your heirs take gets taxed as their income, potentially at a much higher bracket than yours ever was. The tax-free structure doesn't just help you, it extends past you. None of this requires you to be a tax expert or to make a perfect decision today. It requires understanding that the label retirement account hides two fundamentally different tax outcomes, and that the account you default into isn't necessarily the one that serves you best. If you're early in your career and in a lower tax bracket than you expect to be later, the Roth structure works heavily in your favor, because you're paying tax now at a lower rate in exchange for permanent tax-free growth. If you're in your peak earning years, a traditional account's immediate deduction might carry more weight, and a mix of both gives you flexibility neither one offers alone. The system isn't hiding this from you out of malice. Nobody in the process, not your employer, not your bank, not the IRS, is specifically responsible for making sure you understand which bucket serves your future self best. That responsibility landed on you the moment you got your first paycheck, and nobody handed you the manual. You're not behind because you didn't know this. Most people don't, and the ones who do usually found out by accident, from a coworker, a video, a conversation that happened to come up at the right time. But now you know the mechanism. You know the 5-year rule, the age requirement, the contribution ceiling, and the workaround for it. That's enough to go check which bucket your money is actually sitting in right now and decide if that's still the right call. If this changed how you think about your own retirement account, subscribe. because there's a lot more sitting in the tax code that works the exact same way, quietly built for you, and never explained clearly until now.